Property Investing Insights, your authority on all things property investing, finance and wealth creation with Right Property Group.
G'day and welcome to Property Investing Insights. And as usual, this is the meatier stuff. This is about client stories, and this is without Phil. So, we'll get the real stuff done over here today. And today with me, I've got one of my favorite clients, Daniel Murray. His journey is one that I think it needs to be shared because there's all this rhetoric right now that you really can't be looking at doing a portfolio at rapid succession. We did have a purpose to get the properties done really quickly. Daniel, welcome.
Thank you. Good to be here.
And thanks for coming at short notice. We were really thinking of who do we bring on, and Maxine from office then said that Daniel's been a star over the last 18 months, and we've built up a portfolio. But before we do that, let's talk about you first.
Yep.
Who is Daniel?
So I'm a 44-year-old young man. I've been in business pretty much for the last 23 years. I've had a commercial property maintenance business. So we've got some pretty big corporate clients. That's pretty much been my bread and butter for the last 23 years. And then 3 years ago, I decided to open a franchise restaurant, a Lone Star Rib House, just to venture out and try something different. So it's been a very interesting last few years.
Is that a well done thing, or?
It's questionable, up and down. It has its moments.
So you still got the restaurant?
Still got the restaurant, yes. Yeah.
Okay. So for those that are listening, if you want a discount, mention RPG and Lone Star.
Edmondson Park.
Well, there you go. So obviously you've now got two businesses. You've got the maintenance business, the construction business, and also the restaurant business. Very diverse. What was the thought process in getting into that business?
I've always loved hospitality. I love cooking. I've got a French background.
Right.
After COVID, I sort of seen an opportunity to start the business, but I was too scared to start something by myself without all the systems in place. Yeah. And that franchise just had everything set up. All the systems were in place. The training was available. So we ventured out, found a nice little location in a new shopping centre in Edmondson Park. Yeah. And that's how that began.
Yeah. And with the construction business, how long have you been in the construction business?
So 23 years this year. It's been a very roller coaster 23 years. It's a business that fluctuates. We have very busy periods, some quiet periods. Clients change. They move between different companies. But the last 3 years for us has been really, really good. Had some really big growth. Picked up some big portfolios. And we just continue to grow.
Yeah, no, fantastic. And so today, with the way employment works, how are you with staffing?
Staffing is still a little bit short, trying to find the right balance. We have a business where it's sort of involves everybody to be a bit experienced in every trade, which is a bit hard to find. But so in Champagne Building, we have 15 full-time staff and some contractors that help out when we're busy. But as I said, we're continuing to grow and trying to find a right team to get the growth with us. Yeah.
Because what I find is that as employment becomes readily available, industries like yours and property management industry, and in fact, anything that's related to property tends to lose a lot of employees, or they're harder to find because there's so many other jobs available. And have with the way you're seeing the construction industry, and we'll talk about your portfolio in a minute. With the way your construction industry is panning out, has there been a marked difference pre-COVID and now?
There's a lot more choice for employees, definitely. Yep. So our team, my guys are very loyal. They're well looked after. So I think that's the difference that we have. We've had a couple of people leave over the years, and they've recently come back because they've tested the market. They've seen what other companies are like. So we'll find that they do come back. But employment-wise, there is a lot of choice out there, and I see that in interviews when they come and sit down with me. They're very demanding, where, 10 years ago, we would ask the questions and what they could do for us. Now they're asking the questions, what can we do for them?
Yeah. I guess there's also a change in the guard in that sense.
Huge difference. Yeah.
So we always hear these anecdotal evidence of costs increasing in the building industry, owning lots of properties and helping clients with their portfolio. We are seeing this clear escalation of costs. How have you found that in your work?
It doesn't impact us a lot because ours is mainly commercial, so we stay away from the residential. So we're very fortunate where our customers bear the costs. So we're not dictated by pricing like residential.
Yeah. So there's a clear divide between
Definitely.
you and residential.
Yeah,
So,
yeah, definitely.
Fantastic. And so you are put in touch with us through our good friend Scott.
Yes.
And that was about a year and a half, 2 years ago. What was the full process in that? How did this eventuate?
To cut a very long story short, being in business for, I think it was 20 years back then, we had an accountant who just was an accountant. So every year he would just give us paperwork to sign, and that would be pretty much it. Scott recommended us to a very good accountant, Manzuro, who pretty much just said to us on day one, what are your goals? What would you like to do? And we said, start investing in property. So we got that target of what we wanted to achieve, and then spoke to Scott, and Scott put us in touch with you. And from there, our growth in 18 months was just rapid fire, I guess. Very, very quick.
Yeah, and it's really important, right? So this is where advisors, and especially running a business, you need to have good advisors around you.
Yeah.
And you often don't know how good your advisor is until the results start rolling in.
Yeah.
And by changing the accountant, which was the catalyst to you to get started in the portfolio, and then also the support from the accountant, the broker, and from the property strategist to help that rapid growth, was really crucial. Because if you look at it from where you were, there's many years of owning business without having substantial property ownership. You do have a home, you do have a commercial property in a portfolio when you started. The big difference was getting that catalyst of professionals into the mix.
Definitely.
Yeah.
Yep.
And so, if without naming names, I suppose, if you compare the advice you're getting previously to the advice that you then got to help you start the journey, what was the big difference between the two?
I guess having the quarterly meetings with current accountant, and he would continue to ask, what are your goals? And he would put in place what your figures are, what your potential goals could be with the numbers that you're providing. Whereas previously, as I said, it was just a matter of, here's the paperwork at the end of the year, sign it. There was no questions asked, what would you like to do? And then being a business owner, you're always told that it's very hard to get money. No one wants to touch you. And that's always been the mindset being in business. And a lot of business owners think that way too. But being in that meeting, as we sat down and we realized, we could take X amount of equity out of what we had, and then that's the advice that we were given. And then having that quarterly catch up with where we are and the goal setting meetings, it's very important to have.
And you've touched on the key, right? So one of the concepts we're discussing this year is designing a decade, and one of the most important bits in designing a decade is actually having planning all along the way.
Yeah.
And from what you're telling me, you're catching up with the accountant every quarter, which is really important, because you are then checking into your cash flow, you're checking into your goals, projections, and you're looking at opportunities pretty much 4 times a year, as opposed to maybe once a year when you're doing your end of year financial year tax returns.
Yep.
And by the time the boat's already sailed.
Yeah, exactly.
And so with these discussions that you have, what's the flavor of it? Are we talking cash flow? Are we talking asset accumulation during a time, or just simply talking opportunity?
Everything's brought up in the meeting. That's a 1 hour catch up. So we talked about cash flow, and where we want to grow, if we want to just have a break for a little bit, because that period for 18 months was very quick, rapid fire, a little bit stressful, especially for the wife. So yeah, it's been, the meetings cover everything.
Yep.
It's good. Yep.
Yeah. So we bought 4 properties pretty much in rapid succession in that 18 months.
Yeah.
And you mentioned that it was a little bit stressful for Brooke.
Yep.
How were you able to manage in the sense that you grabbed it by the horns and you charged, whereas Brooke was perhaps a little bit more cautious in her approach?
Very cautious. We're 2 different people. I'm a risk taker, and she likes to go slow.
Yeah.
So getting that first property, there was a lot of discussion, a lot of back and forth, and we both agreed on that first one.
Yeah.
And then once you've seen how easy the process was dealing with you guys, because you guys handle everything from A to Z really, and then she seen how easy it was, and then that just made our decisions easier moving forward.
We paid her lots of money to say those things. Wouldn't surprise me. So obviously, when you have a partnership like this, and when I look at our journey, Reshmi and my journey, initially Reshmi was very cautious, and I was the risk taker.
Yeah.
But it does flip up after a little while, where Reshmi started seeing the success, and now it's to the point where I'm the cautious one, and Reshmi is the let's go.
Right.
So that's going to change over a period of time as the portfolio develops, because all of a sudden the roles change, where one stops becoming the nurturer and becomes the person that progresses the portfolio, and you're trying to hold on to what you've got because if you've seen success.
Yep.
Yeah, it's quite normal. So our first property, obviously, that was in Campbelltown.
Coria. Coria was the first property. Yes.
Yeah. That was so Coria, for those that don't know, that's down in Victoria, and this was a development site right directly across from the shopping center.
Yep.
Now most people see buying across busy shopping centers as a negative, but we saw opportunity at this. Yep. And the important thing was that you are able to see the vision of this property, and you're able to jump onto it pretty much straight away. It's certainly, we are not going to win any awards for beauty in terms of the properties, but the location of it made for what it was. So take me through the process of how you made a decision on that one.
That property had the potential, which she provided us with the duplex further down the track. The rental yield, I think, was coming in at just over 5% by memory. Yep. So look, for us, it was the first one to jump in. It was I think the property price was around the 550, 520. So it was good value, first property to jump in at. So that was what we were thinking.
So it's not really stretching ourselves. The yield was fairly good, and the location could be built.
It wasn't a huge investment for us, so good one to start.
Yeah, and it was also interstate as well. So you're complicating it pretty much straight away by investing interstate.
Yep.
Obviously, we're based in New South Wales. And was there what's the word I'm looking for? Was there a trepidation that you're buying interstate and you don't really know the area?
A little bit scary. I think it was Maxine that had said to us, one of your staff, because my wife, she wanted to take care of the house and nurture the house, and then Maxine said to her over the phone, just forget about don't care too much about the house, just use it as an investment only, and it's there to make you money.
Yeah, which is important, right? So because when you're starting out on a portfolio, and I'm guilty of that as well, when you first started out, you overthinking the things that don't really matter. Which is, how am I going to do the maintenance? Or if the tenant falls behind in rent, how am I going to manage that?
Yeah.
But you've got professionals to manage that, right? So, and the thought of, okay, I want it right in my backyard, so I'll drive past it and have a look.
That's what we were thinking. Yeah.
And the reality is that when you've got the investments, you rarely drive faster. I mean, I've got properties that are pretty much within 5 minutes driving distance to where I live.
Yeah.
And I've probably seen more of my interstate properties that, there's 5 minutes from me.
Okay.
You just look at the numbers.
Yep.
Yeah. So numbers wise, how has that performed?
Growth wise, not a great deal, but look, the rent, we've got great tenants in there. The rent's on time every week. That's a property that just manages itself. We've got a great agent down there as well.
Yeah.
It's been really good.
Fantastic. And that you've pointed something out really important, right? Is that most people would expect growth immediately because that's what seems to be portrayed on Facebook and TikTok.
Yep.
We need to be looking at from where we're picking it up in the cycle. And with that particular property, you pick it up at the bottom of the cycle. We're waiting for that to turn, which is now turning.
Yeah.
And a clear way of knowing how it's turning is because the yields are starting to compress, right? So you can't get the 5% yields in those areas for houses there anymore. And it became a cornerstone in your portfolio because we've reserved that to come back to it at some point in time and do the development on it, whether we knock down the house, put a duplex, whether we subdivide and put another house at the back, or we turn it into professional suites because it's directly opposite to the medical to the shopping center. From there, we then of course leveraged off onto the next property. And where was that one?
That one was in Campbelltown, so that was the house and granny flat package.
Yep.
That one we bought was just around the corner from home, and being in the industry we did a quick sort of make good to turn it around. And at least I think within 2 or 3 days we had tenants in it.
Yeah. So that was well within your skill set, because that's something you do day in, day out. You've got the connections to actually do that. Now, $1 million question. After you've done the renos and all that, how many times have you driven past it?
Probably 3 times. 3 times in 6 months.
Yeah.
My wife a little bit more.
Yeah. Is that's what the novelty of it starts to wear off.
Definitely.
And you just look at it from its performance point of view. Holding a property that's also got a secondary dwelling on it does bring in a little bit of complications in terms of getting the tenancy mix, getting the agency right as well to manage it.
Yeah.
How did you step through all those things?
This one was a little difficult because I had my daughter in the granny flat, and there was a clash of personalities between the house and my daughter. Unfortunately, my daughter moved out after 3 months, which, as I said, within a week we had at least out to another tenant. We haven't heard anything since they've been in. It's been a great investment. Both tenants get along well. Agents looking after that one for us. So there's no headaches at all, that one.
And so insurance-wise, you've got 1 building insurance and 2 landlords insurance.
Yes.
And it's important to be insured. A portfolio that's probably about now 18 to 2 years down the track, almost 2 years down the track. Have you had any insurance claims?
Nothing. No.
Nothing at this stage.
Nothing.
But you're still insured.
Definitely still insured. But no insurance claim, and hopefully none in the future.
And this is what insurance is all about, right?
Yep.
You paying premiums with the hope that you never have to claim on it, because claiming on it is that there's something's gone wrong. Just like life insurance. So from there, we then decided, change things around. So we've got a development site in the portfolio. We've got a dual income in the portfolio, both of which have got further value add. The value add in the Campbelltown one obviously is that you can do a full rent on it and substantially increase the value. And the Corai one obviously is the one where we can do a development on it. Where did we head from there?
Back to Victoria. I was proposed 3 1-bedroom units on the one block of land. As soon as we seen that opportunity come up, we jumped on that one as well.
And your purchase price on that one?
Purchase price was $640.
Okay. And I remember driving past this one when I was in the area. Right, it certainly will not win any beauty contests.
Yeah, definitely.
Because it's what we call the toilet block, right? So here it's got a flat roof with hardly any tilt on it. It's just low set brick. I've got a few overgrown plants around it, and
minimal overheads.
Then the presentation on it was not that. So what works did you have to do to this property?
We haven't really done a great deal. One of the units was fully renovated, so 2 were still original. Other than just chop a few trees out the front, a bit of rust treatment on the roof, gutter repairs. Other than that, that's pretty much all we've done. And there's a big block of land at the back, so there's still potential to put a 4th 1-bedroom unit in the back as well.
And we're not far from the shopping center, obviously.
Just around the corner.
So no, this is regional, right? This is a regional area. And was there a marked difference with your Campbelltown and your Geelong property to this regional area in terms of communication with property managers, in terms of getting work done?
It's been really easy. They've been great, and my wife's from the area too, so she's familiar with that area. That's been really easy, that one.
I didn't know that.
So it's been very easy.
So obviously that was 3 strata tiled units, so that they're already separately titled.
Yes,
and so that's got very clear exit strategies out of that. So if I come back to the portfolio, each property that we bought had a very easy exit strategy out of it. So if I look at the one in Geelong area, the exit out of that is it needs a little bit of TLC. From what I could remember of the property, it had these old floral carpets in there.
And the old blue paint and yeah.
So if we did spruce it up, then certainly it'll bounce up in value and we'll be able to exit out of it even in a bottom of market scenario. And the one in New South Wales, which is the House Plus Granny Flat, that had a renovation tilt to it. So we were able to add value to it pretty much straight away by doing some cosmetic renos to it. And we could see the trajectory in that area in terms of how dual occupancies were traveling. And so that had a clear exit. And then, of course, the one in the regional, the block of 3, that had 2 exit strategies out of it. One was obviously we could renovate each unit and offload it. And then the other was really creating another dwelling to it, whether getting the DA or with a accurate building. And that would increase the value and also increase the what I call the get out of jail card on the property. Right? So every property that we bought with a clear intent that it may go wrong or life focus may change. And so we need to be able to offload that at any point in time in the cycle in that area. And obviously each property we needed to be able to extract our deposit back out at some point in time. Have we gone around refinancing these yet or not yet?
Not as yet, no. We'll probably reevaluate in July, I think, this year.
And the reason for doing it in July is because they have to do a tax return.
Yeah, exactly.
So, okay. There's an enter the accountant, get it done. And so obviously that once we've done that, now we sort of tapped out personally in terms of holding properties within entities outside. We've then set up a self-managed super fund, which you already had because your business is housed in one of the properties that are owned by the self-managed super fund. We then put a residential property in that self-managed super fund. And where did we head for that?
That was in Western Australia. So really venturing all over the place.
Yeah. And that was really counter-cyclical, right? So that market was coming to a peak. But it was something that was renovated. It was more of a set and forget. And because we've got plenty of time in terms of reaching the self-managed super fund goal, which was just a tuck away, and it complemented the commercial one. And high-level plan for that, which we discussed, was at some point in time we could sell the residential to pay down the commercial and unmask the income of it, even though the income's actually coming from the business paying rent. But at some point in time, you might want to be able to move to different premises and get better income out of the commercial.
Definitely.
Now, once we've done all of that, what's the plan going forward?
So that was very, very quick process. All those properties happened within 18 months.
You actually needed a holiday, right?
Yeah. So we went to Europe to get away and have a break. Now everything's calmed down, settled down. The dust has settled. We're probably looking in the next 2 or 3 months to start again. It's either going to be in commercial or residential, but we've set up a family trust to move forward now.
Okay, so it's a clear progression. So you bought properties in your personal name. Now you're moving on to entities, which has got better tax planning, got a better estate planning down the track. So this is the advice coming through, right, from the accountant, from the broker, and from
exactly. Yeah.
Which is important, right? So often when people get started, they try and overcomplicate it with you run a business. So usually the advice could be, just do it in a trust. But the advice was to do it in where you could get the money first, right? Get into the market, and then we can then start looking at different entities at that point in time. So if you were to start this journey all over again, I know it's a really short journey so far, short but pretty fast. If you were to start all over again, what would you do differently?
Differently, I don't think I would, because having the team giving us the advice, the accountant, yourself, the broker, it's been absolutely incredible, because over the 20 years we've had no advice, never been told what to do. Everything I've done is just pretty much guessing by myself of how to do it. And having the advice from everyone around us, they're telling us how to do it, when to do it, what to do, and even the future opportunities with each property. So I can't see myself doing anything differently, because it's been it's been a great experience.
Yeah, yeah. What's something that keeps you up at night?
Oh, up at night with the portfolio or the business, lots of things. I don't sleep very well.
Cut down on the coffee.
Yeah. Regarding the portfolio, look, it's always a fear. If anything goes wrong, if a tenant moves out, how are you going to cover the income? There's always, especially with my wife. My wife is very cautious, as I said. It's always in the back of your mind. If there's a problem in the property, how can we cover the costs? Because since we've purchased all that, sometimes the budget gets a little bit tight.
Yep.
And that's always in the back of your mind. But touch wood, we've been very, very lucky.
Yep, yep. So one of the things I do in my portfolio is I set aside buffers within my portfolio. I'm a little bit more aggressive, so I only put aside 1 to 2 months for full repayments to assume that the portfolio is vacant, the whole portfolio is vacant, and I need to stump up the cash for the mortgage repayments for those next 2 months, and that's my sleep at night factor.
Okay.
So what are some of the measures you've implemented in your portfolio?
It's the same, creating the little buffer zone, just for those emergencies. We always try and keep, X amount of dollars for those problems. And we've also got 4 kids, so expenses, kids are expensive. So there's a lot of money coming out rather than coming in at the moment, especially with the school fees, the start of the year, new uniform, shoes, etc. So, yep.
So investing is happening in the background, life's at the forefront, or is it at the moment investing right in the forefront?
50-50 on that one still. Yep.
Okay.
So,
and let's talk about your social network. Now, obviously, when you've got a few properties in the belt, you may want to talk about it, or people get to know that, hey, you've bought properties rapidly. What was some of the advice that you got from your network? And the second tier to the question is, what were some of the pushback you got from a network?
I'm a very closed person, so I haven't really discussed what we've done other than with my parents. So my parents are property investors as well. They've got a nice healthy portfolio. So I get a lot of advice from mum and dad as well. So they've been very supportive, and they're always around the corner for a bit of advice. But
Yeah. And so, what's one takeaway advice that they've given you in your journey?
That's probably where I got my lack of fear and risk taking from them. They said, just don't be scared, just do it.
Yeah. Here's the worst thing that can happen is it actually doesn't work out and stagnates, right?
Yeah.
But there's always an end buyer to the property, because we're always looking at it from a viewpoint that the property needs to be made attractive to an owner-occupier, not an investor, because that's a true exit, right? So if we go back to all of the properties, the location of it actually makes it a prime owner-occupier property, even though they're 1-bedroom units like in the regional areas. It's right across the shopping center, walking distance. Same with the one in Geelong, which is across there. And the way the floor map was done, it actually had a spacious feel. So an owner-occupier, first home buyer would still look at those properties, as opposed to if it's just made for investors where it's focused totally on the yield, then there's no real exit strategy out of it.
The market's much smaller. Yeah.
Yes. Yeah, that's right. Yeah. So apart from property, what else do you do in terms of investing?
Look, I dabble a little bit in Bitcoin and the crypto, but I'm horrible at that. It started off good, and then I've chopped and changed. So I logged in the other day, and a bit of a disaster there. But did some lithium mining investing a few years ago, which went pretty well. Unfortunately, I pulled out just on the lower part of the time. I should have pulled out sooner, but
It's a bit like me. I know property I do really well. Shares, especially if it's active share trading, I don't fare that well, because I'm too complacent in terms of people think I'm too aggressive with investing, but I'm too complacent, so I miss the peaks.
Yeah.
Whereas if you're looking at shares as a passive investment, then obviously it needs to be set and forget, right? So it needs to be like your WA property.
Yeah.
Where it's there, it's doing its job, it's looking after itself, and you don't hear about it. Yeah. So someone is starting the journey today. knowing that you bought 4 properties in 18 months, what advice would you give them?
Look, be cautious. Definitely be cautious, and don't be scared to do it. That's the biggest part of advice. It is very daunting, but if you get the right support people behind you giving you the right advice, it should be a really, really smooth process from the beginning.
Yeah. So we wouldn't advocate you go as hard as Daniel has. You are well positioned financially to be able to do that. It is harder to build rapidly, but it is not impossible in today's market. I guess the biggest thing is that if you listen to stories about people that have bought, say, 5, 6, 7 in a year, in the yesteryears, the prices were lower. The yields were better, but now the prices are much higher. The yields are compressing. And just as importantly, the difference between the money coming in and the money going out is quite more substantial now with the higher interest rate. So whilst it is possible, you can still build a substantial portfolio. You just need to have a thought out process. There needs to be planning. You need to be meeting with the accountant every quarter.
Definitely.
You meet with the advisors every quarter. And check in the portfolio, making sure that you've got performance happening in terms of rents coming in, maintenance being done, the right types of maintenance, and checking in terms of where the value is tracking, so that you can then look at finance, how the mortgages are, and when it is time to restructure mortgages. So we haven't reached that stage as yet in terms of restructuring mortgages.
Yep.
I know that the ones in the super fund, they're principal and interest at this stage, whereas the ones outside are interest only.
Everything's interest only. Yep.
What about the home? Is that principal and interest or about interest?
That is principal and interest. Yep.
So the home we want to pay down, obviously.
Yep.
And with the investments, we want to make a minimum cash flow cutting out so you can hold multiples. For any final words of advice to anyone that's perhaps listen to this and say, I'd like to get started, but I don't know where to get started.
Look, as I said previously, just get the right people around you, build the right network, and listen to the experts. I mean, everything's there. The tools are there. And again, don't be scared. Just get into it. The first one's the hardest. After the first one, that's much easier.
Yeah, fantastic. Daniel, it was a pleasure having here in the office. We're still recording in the offices as we wait for our studio to be ready.
Thank you, Victor.
And thank you for coming in on a rainy day and away from business. I really appreciate that. And I know that your story will resonate with the rest of the crew.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.